Most financial conversations begin with numbers. Salaries, expenses, market prices, investment returns, and cost comparisons dominate how people learn to think about money. From early adulthood, financial responsibility is often framed as the ability to spend carefully, avoid overpaying, and seek the lowest reasonable cost. On the surface, this appears logical. Careful spending suggests discipline, intelligence, and awareness. Yet beneath this habit lies a deeper psychological pattern that quietly shapes long-term wealth outcomes, the difference between thinking in terms of price and thinking in terms of value. Price is immediate. It is visible, measurable, and emotionally clear. Value, however, unfolds over time. It requires interpretation, patience, and tolerance for uncertainty. Because price provides instant clarity while value requires judgment, many people naturally anchor their financial decisions around cost rather than outcome. This tendency does not originate from lack of intelligence. It often originates from early financial conditioning. Individuals raised in middle-class or financially cautious environments learn to associate safety with minimizing expense. Avoiding waste becomes synonymous with responsibility. Spending less feels morally correct, while paying more triggers subtle discomfort. The mind learns to equate frugality with wisdom. As income increases later in life, this mental framework frequently remains unchanged. Professionals who earn strong salaries may still evaluate decisions primarily through cost comparison. The question guiding choices becomes, how much does this cost, rather than what does this create over time? This distinction appears small, but carries profound consequences. Price-based thinking focuses attention on short-term financial outflow. Value-based thinking evaluates long-term return, not only financially, but also in terms of time, opportunity, learning, and future leverage. Wealth building depends heavily on recognizing this difference because many of the decisions that generate long-term advantage initially appear expensive. Now something subtle becomes visible. Price thinking often provides emotional comfort. Choosing the cheaper option delivers immediate psychological reward. It reinforces identity as responsible and careful. The decision feels safe because less money leaves the account. Value thinking feels different. It requires accepting temporary discomfort in exchange for uncertain future benefit. Paying more today without guaranteed results challenges deeply ingrained financial instincts. The brain experiences tension because value cannot be confirmed immediately. Fear favors price. Growth favors value. You may notice how professionals sometimes hesitate to invest in education, tools, networks, or experiences capable of accelerating long-term progress. The hesitation rarely comes from inability to afford the investment. It arises from evaluating the decision through cost rather than outcome. The price feels real. The value feels theoretical. Over time, repeated price-focused decisions create an invisible pattern. Individuals successfully avoid unnecessary expenses, yet also avoid opportunities capable of expanding income, skills, or optionality. Financial life becomes efficient, but limited. Money is preserved carefully, but wealth grows slowly. This is why broke thinking can exist even at high income levels. Broke thinking does not necessarily mean lacking money. It describes a mindset oriented toward minimizing loss rather than maximizing value creation. The individual becomes skilled at saving, but less practiced at recognizing investments that multiply future opportunity. Now the perspective begins to shift. Wealth builders gradually learn that money functions not only as something to protect, but as something to deploy intelligently. They evaluate decisions based on outcomes across years rather than immediate affordability. The central question changes. Instead of asking, "Is this expensive?" they begin asking, "Is this valuable relative to the life I am building?" This shift does not encourage careless spending. It introduces intentional spending. Resources move toward opportunities that create leverage, while unnecessary consumption loses appeal. Understanding the difference between price and value marks the beginning of financial maturity. It reveals why two individuals earning similar incomes can experience dramatically different long-term outcomes. One protects money carefully, the other positions money strategically, and the distinction between those two approaches quietly determines whether money remains something managed cautiously or becomes something capable of building lasting wealth. Now we will explore why focusing on price feels emotionally intelligent, even when it quietly limits financial growth. Price offers certainty. It provides an immediate answer to a decision that might otherwise feel complex. When evaluating a purchase, the lowest cost appears objective. There is no ambiguity, no interpretation required. The cheaper option feels measurable and therefore rational. The brain prefers clarity. For professionals accustomed to analytical environments, measurable decisions reduce cognitive effort. Comparing numbers creates the impression of control. Choosing the lower price delivers psychological closure. The decision feels optimized because loss appears minimized. Safety becomes associated with reduction. This association forms early. Many people grow up hearing subtle financial messages emphasizing caution. Avoid wasting money, search for discounts that compare prices carefully, and never overpay. These lessons carry genuine value, particularly during periods of limited resources. They help build discipline and prevent impulsive behavior. But habits developed for scarcity often remain active long after scarcity disappears. As income rises, the emotional reward of paying less persists. Saving money on individual transactions continues to feel like financial success. Yet wealth building rarely depends on minimizing individual expenses alone. It depends on allocating resources toward outcomes that expand earning capacity, time freedom, or long-term advantage. Price thinking narrows attention to the present moment. When decisions focus primarily on cost, the brain evaluates affordability rather than impact. A cheaper solution feels safer because immediate loss appears smaller. The possibility that a higher-priced option might produce significantly greater value remains psychologically secondary. Fear reinforces this pattern. Spending more introduces uncertainty. The mind begins asking whether the additional cost will truly justify itself. Without guaranteed results, higher-value choices feel emotionally risky. Choosing the cheaper option eliminates doubt instantly, even if long-term outcomes suffer. Avoiding regret becomes more important than creating opportunity. You may notice how this appears in professional environments. Individuals hesitate to invest in mentorship, advanced education, superior tools, or environments that accelerate growth. The hesitation rarely comes from lack of awareness. It comes from evaluating decisions through short-term cost rather than long-term leverage. The price feels concrete. The future benefit feels abstract. Over time, price thinking builds an invisible ceiling. Individuals become highly efficient at protecting resources, but less comfortable deploying them strategically. Financial life remains stable, yet progress slows because opportunities requiring upfront investment are repeatedly postponed. The irony is subtle. Price-focused individuals often believe they are behaving responsibly while unknowingly limiting future income expansion. Wealth creation frequently requires tolerating temporary inefficiency, paying more today for outcomes that compound tomorrow. Safety shifts meaning at this stage. True financial safety does not come solely from spending less. It comes from strengthening the capacity to create value repeatedly over time. Investments that expand skill, access, or opportunity may appear expensive initially, but reduce long-term vulnerability dramatically. Now the perspective begins evolving. Professionals who transition toward wealth thinking start recognizing that minimizing price does not always minimize risk. Sometimes, the lowest cost decision carries the highest long-term cost because it delays growth. They begin evaluating decisions differently. Instead of asking whether something is cheaper, they ask whether it improves capability, saves meaningful time, or increases future options. Cost remains relevant, but it no longer dominates judgment. Fear loses influence when value becomes visible. And once price stops defining intelligence, financial decisions begin aligning less with short-term comfort and more with long-term expansion, allowing money to function not merely as something preserved carefully, but as a resource intentionally directed toward building lasting advantage. Next, we begin to understand why price-focused thinking persists even after financial circumstances improve. The lasting psychological imprint of scarcity. Many professionals who achieve stable or high incomes carry invisible financial memories formed long before their current success. These memories are rarely dramatic. They consist of ordinary moments, watching parents compare prices carefully, postponing purchases until absolutely necessary, hearing conversations about financial limits, or sensing tension around unexpected expenses. Scarcity does not need to be extreme to shape perception. The developing mind learns an implicit lesson. Money must be protected because losing it creates instability. Spending becomes associated with risk rather than possibility. Carefulness becomes synonymous with intelligence. These beliefs form quietly and remain active even when external reality changes. Income may increase, but emotional conditioning updates slowly. As adults, professionals often retain subconscious rules learned during earlier financial environments. Paying more than necessary triggers discomfort, even when affordability is unquestionable. Expensive decisions feel emotionally heavier than inexpensive ones, regardless of potential return. The brain continues operating under outdated assumptions. This explains why individuals earning strong salaries may still hesitate to invest in opportunities capable of accelerating growth. The internal voice does not necessarily say, "I cannot afford this." Instead, it says, "This feels like too much." Feeling replaces analysis. Scarcity memory encourages minimizing visible loss. Choosing lower prices produces emotional reassurance because it aligns with familiar survival strategies. The mind interprets restraint as protection against future uncertainty. But wealth requires a different relationship with uncertainty. When financial life improves, the challenge is not only increasing income, but updating psychological models formed under previous conditions. Without this update, behavior remains optimized for avoiding scarcity rather than building abundance. Price thinking becomes emotional habit rather than logical strategy. Now something subtle becomes visible. Scarcity memory often coexists with professional success, creating internal contradiction. Individuals may perform confidently at work, manage complex responsibilities, and make high-impact decisions professionally, yet feel unusually cautious when allocating personal financial resources. Competence does not automatically translate into financial confidence. The hesitation stems from emotional association rather than lack of knowledge. Spending more still feels dangerous because the brain remembers earlier vulnerability more vividly than current stability. Fear protects the past even when the future has changed. Wealth builders gradually recognize this dynamic. They understand that disciplined spending remains valuable, but they separate thoughtful restraint from inherited fear. Financial decisions begin reflecting present capability rather than past limitation. This shift requires awareness rather than risk-taking. Individuals start asking whether hesitation reflects genuine evaluation or emotional residue from earlier circumstances. When decisions are re-examined through current reality, many opportunities previously dismissed as expensive reveal themselves as investments in growth. Value becomes easier to recognize once scarcity loses authority. Over time, the psychological transition unfolds quietly. Money stops representing something fragile that must be preserved constantly and begins representing a tool capable of creating future leverage. The goal is not abandoning caution. It is aligning financial behavior with present conditions instead of past fears. And once scarcity memory no longer defines financial judgment, professionals begin moving from protecting money toward positioning money, allowing wealth to grow not only through income, but through decisions informed by updated self-perception and expanded possibility. Now the perspective shifts toward one of the least visible consequences of price-focused thinking, the gradual reduction of opportunity. Opportunities rarely announce themselves as financially efficient. In fact, many of the experiences, relationships, and decisions that create long-term wealth initially appear expensive, inconvenient, or uncertain. Because value unfolds over time, opportunities often require commitment before outcomes become obvious. Price thinking struggles in this environment. When decisions are filtered primarily through cost, the mind automatically eliminates options demanding higher initial investment. The evaluation ends before deeper analysis begins. Opportunities disappear quietly, not because they lack merit, but because their price feels uncomfortable. The loss is invisible. Unlike poor financial decisions, missed opportunities rarely create immediate feedback. There is no clear moment signaling that growth has been sacrificed. Life continues normally. Stability remains intact. The absence of progress feels indistinguishable from safety. Over years, however, this pattern accumulates. Professionals may notice that career trajectories plateau despite consistent effort. Income grows incrementally rather than exponentially. Networks remain familiar rather than expanding into environments where new possibilities emerge. Financial life becomes predictable but constrained. Price thinking optimizes for efficiency, not expansion. Many high-value opportunities carry characteristics that appear irrational at first glance. Advanced education programs, strategic relocations, entrepreneurial ventures, premium professional environments, or high-quality collaborations often involve significant upfront cost without guaranteed return. Fear interprets uncertainty as unnecessary risk. Choosing the cheaper alternative preserves short-term resources while reducing exposure to environments where leverage develops. The individual remains competent and financially responsible, yet access to transformational opportunities remains limited. Wealth often grows through access rather than effort alone. Access to better information, stronger networks, higher-level conversations, and environments that challenge existing thinking can dramatically alter long-term outcomes. These advantages rarely appear inexpensive because they create asymmetrical return over time. Price thinking undervalues asymmetry. The brain compares visible cost but struggles to quantify invisible advantage, and paying more feels inefficient even when the potential upside outweighs the expense many times over. Now something subtle becomes visible. Price-focused decisions frequently concentrate attention on minimizing downside while ignoring upside magnitude. The mind treats all financial decisions as symmetrical, risking $10 to gain $10, even when certain opportunities offer disproportionate reward. Value thinking recognizes asymmetry. Professionals who transition toward wealth-building behavior begin evaluating decisions based on potential trajectory rather than immediate affordability. They consider how an environment might change perspective, how a relationship might expand opportunity, or how a skill might multiply earning capacity. The decision framework changes entirely. Instead of asking whether something costs more, they ask whether it changes future direction. Some opportunities justify higher cost because they shift long-term positioning rather than produce immediate return. Fear loses influence when opportunity becomes measurable. This does not eliminate discernment. Not every expensive option carries genuine value. The difference lies in expanding evaluation beyond price alone. Decisions become analytical rather than reactive. Over time, this shift widens financial possibility. Opportunities once dismissed as expensive begin appearing strategic. Resources move toward growth rather than mere preservation. And as opportunity expands, wealth development accelerates quietly, not through reckless spending, but through recognizing that the true cost of price thinking is often not what is spent, but what is never pursued. Next, we begin to understand a paradox that reshapes financial thinking. Decisions that appear inexpensive in the moment often become the most costly over time. Price thinking evaluates transactions individually. Each decision is judged in isolation: the cheaper tool, the lower cost service, the minimal investment option. On the surface, these choices appear efficient because less money leaves immediately. The emotional reward comes from feeling financially prudent. But financial life does not operate through isolated moments. Every decision interacts with time. Outcomes compound. Small differences in quality, efficiency, or capability accumulate silently. What begins as a minor saving can evolve into significant long-term cost when repeated across months or years. Cheap decisions frequently trade future advantage for present comfort. Consider how individuals approach professional resources. Choosing the lowest cost solution often introduces hidden friction, reduced reliability, slower performance, limited capability, or repeated replacement. The price appears lower, yet time, attention, and opportunity are consumed gradually. Time becomes the invisible expense. For professionals, time represents one of the most valuable forms of capital. Lost efficiency compounds far more aggressively than saved dollars. A decision that saves money but reduces productivity quietly limits income growth, learning capacity, and mental energy. Price thinking rarely accounts for this. The brain measures visible financial loss precisely while ignoring invisible opportunity cost. Because opportunity cost cannot be observed directly, it receives less emotional weight. The cheaper option feels safe even when it delays progress repeatedly. Fear reinforces short-term savings. Spending more upfront creates psychological tension because results remain uncertain. The mind seeks reassurance through immediate cost reduction rather than long-term optimization. Avoiding perceived overpayment becomes more important than maximizing effectiveness. This dynamic appears across multiple areas of financial life. Professionals may delay investing in high-quality tools, environments, or experiences capable of accelerating career growth. They conserve resources successfully while unknowingly slowing momentum. Progress becomes incremental because decisions optimize for affordability instead of leverage. Cheap becomes expensive through repetition. Now something subtle becomes visible. Wealthy individuals rarely pursue expensive options simply for status. Instead, they evaluate decisions based on lifetime cost rather than purchase price. They understand that reliability, efficiency, and quality often reduce long-term expenditure even when initial investment is higher. Value emerges across duration, not moment. When financial thinking expands beyond immediate transactions, decision-making changes. The question becomes less about saving money today and more about minimizing friction across years. Investments begin targeting durability and capability rather than short-term savings. This shift alters emotional response. Paying more stops feeling reckless when long-term outcomes are considered clearly. Higher cost becomes associated with reduced stress, improved performance, and expanded opportunity rather than unnecessary luxury. Fear loses influence as perspective widens. Professionals who adopt value thinking begin noticing that many of their most beneficial financial decisions initially felt uncomfortable precisely because they required trusting long-term reasoning over short-term emotion. Money starts working differently. Instead of being preserved through constant reduction, it becomes allocated toward outcomes that simplify life, improve efficiency, and create leverage. Financial decisions align with trajectory rather than transaction. And once the focus moves from price to lifetime impact, the paradox becomes clear. The goal of wealth building is not to spend less at every moment, but to spend intelligently in ways that prevent small limitations from becoming large long-term costs. Next, we begin to understand how price-focused thinking blurs an essential psychological distinction, the difference between buying and investing. Most financial decisions appear similar on the surface. Money leaves an account in exchange for something received. Because the action looks identical, the brain categorizes spending primarily as consumption. The emotional reaction becomes protective. Minimize expense, avoid overpaying, reduce loss. But not all spending serves the same purpose. Buying is transactional. It satisfies an immediate need or desire. The value is consumed shortly after purchase. Investing, by contrast, changes future capability. It increases earning potential, improves efficiency, expands access, or strengthens long-term positioning. Price thinking treats both categories the same. When individuals evaluate investments using consumption logic, valuable opportunities appear unnecessarily expensive. Education feels costly rather than developmental. High-quality tools appear excessive rather than enabling. Strategic experiences feel indulgent rather than transformative. The brain protects money because it assumes depletion. This confusion explains why many professionals hesitate to invest aggressively in themselves, even while comfortably spending on short-term consumption. The emotional system reacts more strongly to visible investment costs than to gradual consumption expense, despite long-term outcomes being reversed. Consumption feels harmless because it is familiar. Investing feels risky because results are delayed. Fear amplifies this difference. Spending on consumption rarely threatens identity because expectations are clear, enjoyment occurs immediately, and evaluation ends quickly. Investment introduces uncertainty. Future return depends on effort, timing, and external factors. Uncertainty activates caution. You may notice how individuals willingly purchase conveniences or entertainment while hesitating to allocate similar amounts toward opportunities capable of increasing future income or influence. The hesitation does not arise from inability to afford investment. It arises from misclassification. The mind perceives investment as loss until value materializes. Wealth builders gradually reframe this perception. They separate spending into categories defined by outcome rather than appearance. Some expenditures reduce future optionality. Others expand it dramatically. Value thinking recognizes expansion. An investment is not judged solely by its price, but by how it alters future trajectory. Does it reduce time friction, increase competence, improve access to higher value environments, strengthen long-term earning power? These questions replace simple affordability analysis. The emotional experience changes. Instead of feeling anxious about higher upfront cost, individuals begin feeling cautious about missed investment opportunities. The risk shifts from spending too much to investing too little in growth. Fear loses clarity when categories become precise. This does not imply that every expensive purchase qualifies as an investment. Discernment remains essential. True investments produce leverage beyond the moment of purchase. They continue generating value long after the transaction ends. Over time, this distinction transforms financial behavior. Money flows more intentionally. Consumption becomes conscious rather than habitual. Investment becomes strategic rather than hesitant. Financial decisions align with long-term capability rather than short-term comfort. And once professionals learn to distinguish buying from investing, the relationship with money evolves, shifting from protecting resources transaction by transaction toward deploying resources in ways that steadily build wealth through expanding opportunity and sustained advantage. Next, we begin to understand why price-focused thinking often persists even among individuals earning substantial incomes. Income growth does not automatically transform financial mindset. Many professionals achieve impressive salaries while continuing to evaluate decisions through frameworks developed when resources were limited. The external situation changes, but internal reference points remain anchored in earlier stages of life. The mind adjusts slowly to abundance. High earners frequently continue behaving as if financial margins remain narrow. They negotiate small expenses intensely, hesitate over investments capable of expanding opportunity, and prioritize short-term savings despite long-term financial stability. From the outside, this appears disciplined. Internally, however, it reflects an outdated psychological model. Success increases income faster than it updates identity. Individuals who spent years learning caution often struggle to reinterpret financial capacity. Paying more still feels emotionally uncomfortable, even when affordability is unquestionable. The brain continues treating money primarily as something scarce rather than something strategic. This creates an interesting contradiction. Professionally, high earners operate within environments where large decisions occur routinely. They manage significant budgets, influence organizational outcomes, and participate in complex strategic thinking. Yet in personal financial life, decisions sometimes remain constrained by price comparison rather than value evaluation. Competence and mindset evolve at different speeds. Fear quietly maintains small thinking. The individual focuses on saving marginal amounts while overlooking opportunities capable of transforming long-term earning power or quality of life. Attention narrows toward immediate efficiency instead of broader trajectory. Price thinking rewards control. Value thinking requires perspective. You may notice how high earners often optimize minor expenses while tolerating major inefficiencies. Time is spent managing small savings while larger opportunities remain unexplored. The behavior feels responsible because effort is visible, yet the overall financial strategy remains conservative. Small thinking feels safe because it is familiar. Expanding financial thinking requires confronting uncertainty about identity. Spending more strategically challenges long-held beliefs about prudence. Individuals may worry about appearing careless, wasteful, or overly confident. Emotional resistance emerges not from financial limitation, but from psychological conditioning. Fear protects familiar behavior even when circumstances evolve. Wealth builders gradually shift focus from transaction-level optimization to system-level optimization. Instead of concentrating on individual prices, they evaluate whether financial decisions improve long-term positioning. The scale of thinking expands. Money becomes a tool for leverage rather than preservation. Now something subtle becomes visible. High earners who remain trapped in price thinking often experience persistent dissatisfaction despite strong income. Progress feels slower than expected because mindset restricts deployment of resources. Financial success exists numerically but not strategically. Income alone does not create wealth. Wealth emerges when financial decisions operate at the level of opportunity rather than expense. Individuals begin aligning spending with future capability instead of past caution. They allow financial behavior to reflect current reality rather than historical limitation. The psychological shift is quiet but powerful. Fear loses influence when identity expands to match financial capacity. Decisions become less about protecting money and more about positioning life intentionally. Resources flow toward growth environments rather than remaining confined within habits designed for scarcity. And once high earners learn to think beyond price, money begins functioning differently, no longer merely accumulated through effort, but strategically deployed to create momentum, flexibility, and long-term financial independence. Now the perspective shifts toward a form of value rarely measured directly but deeply connected to wealth, the value of time. Price thinking treats money as the primary resource under protection. Every decision revolves around how much cash leaves in the present moment. Yet for professionals operating in demanding careers, time gradually becomes more scarce than money itself. This reversal happens quietly. Early in life, money feels limited while time feels abundant. Saving money, therefore, appears logical because hours seem plentiful. As careers advance, responsibilities increase, cognitive load grows, and personal energy becomes finite. Despite higher income, available time decreases significantly. But financial habits often remain unchanged. Individuals continue optimizing decisions to save money even when those decisions consume disproportionate amounts of time or mental energy. The brain still celebrates small financial savings while overlooking the hidden cost paid through attention, stress, or lost opportunity. Price thinking undervalues time because time lacks visible price tags. You may notice how professionals invest considerable effort researching minor discounts, managing small efficiencies, or avoiding higher cost solutions that would dramatically simplify life. The savings feel tangible. The time lost remains invisible. Yet, time compounds differently than money. Money can often be earned again. Time cannot be recovered once spent. When decisions consistently trade hours for small financial savings, long-term capacity diminishes. Energy that could support skill development, strategic thinking, or meaningful rest becomes consumed by optimization at the wrong scale. Fear encourages protecting money over protecting attention. The emotional discomfort of paying more feels immediate, while the cost of time erosion accumulates slowly. Because the loss is gradual, it rarely triggers conscious awareness. Individuals remain busy but feel strangely constrained despite financial progress. Efficiency becomes misdirected. Wealth builders eventually recognize that value must include temporal impact. A decision that saves time, reduces friction, or preserves mental bandwidth often generates far greater return than one that merely lowers cost. Paying more begins to feel logical when evaluated through the lens of life quality and future productivity. Value expands beyond price. This does not mean time should always be purchased at higher financial cost. Rather, decisions become proportional. High-value time receives protection. Low-impact expenses receive less emotional scrutiny. Financial attention moves toward choices capable of influencing long-term trajectory. Now something subtle becomes visible. Individuals trapped in price thinking often feel chronically busy despite strong earnings because their financial decisions fail to protect time effectively. Wealth remains abstract because life continues operating under scarcity conditions. True wealth alters how time is experienced. When financial behavior prioritizes value, resources begin freeing attention rather than consuming it. Simplification replaces constant optimization. Mental clarity increases because fewer decisions revolve around minor savings. Fear loses authority when time becomes the primary asset. Professionals who internalize this shift start evaluating choices differently. They ask whether money spent today creates future space to think, rest, learn, or pursue meaningful work. Financial decisions become aligned with lifestyle design rather than transaction efficiency. Money becomes a tool for reclaiming time. And once time enters the equation of value, the relationship with spending changes profoundly, revealing that wealth is not defined solely by how much money is retained, but by how effectively resources transform time into freedom. Next, we begin to understand why transitioning from price thinking to value thinking often feels emotionally difficult, even for highly rational professionals. Value thinking introduces ambiguity. Unlike price, which provides immediate certainty, value requires interpretation. The outcome cannot be verified instantly. Paying more today involves trusting future benefit that remains partially unknown. This uncertainty activates psychological resistance because the mind prefers decisions that feel conclusively correct at the moment they are made. Price decisions feel final. Value decisions feel exposed. When choosing the cheaper option, emotional risk disappears quickly. There is little fear of regret because the decision appears objectively safe. Spending more, however, introduces vulnerability. The individual must tolerate the possibility that the investment may not deliver expected results. Fear of regret becomes central. Professionals trained to make competent decisions often experience strong discomfort with uncertain outcomes. Value-based choices require accepting that intelligence cannot guarantee success. The decision may still be correct even if short-term results appear disappointing. This challenges identity. Price thinking protects self-image because mistakes appear unlikely. Value thinking accepts experimentation. It acknowledges that growth sometimes requires imperfect decisions. The emotional system interprets this openness as risk to competence rather than opportunity for development. The discomfort is psychological, not financial. You may notice how individuals intellectually understand the importance of investing in growth, yet hesitate repeatedly at the moment of action. Analysis feels complete, affordability exists, logic supports the decision, yet hesitation remains. That hesitation reflects emotional conditioning. The brain equates higher spending with potential loss more strongly than it associates it with potential gain. Even when evidence suggests long-term advantage, the emotional system resists stepping outside familiar patterns of caution. Value thinking requires tolerating temporary uncertainty. Now something subtle becomes visible. The discomfort experienced during value-based decisions often signals psychological expansion rather than danger. The individual is operating beyond inherited financial habits. New decision frameworks are forming. Growth rarely feels comfortable initially. Wealth builders gradually learn to recognize this emotional friction as part of the transition. Instead of interpreting discomfort as warning, they interpret it as indication that evaluation has moved beyond surface-level price comparison. Confidence shifts from certainty to reasoning. Over time, repeated value-based decisions strengthen internal trust. Individuals observe how investments in capability, access, or efficiency compound benefits beyond initial expectation. Experience begins replacing fear. The emotional response changes slowly. Spending more strategically stops feeling reckless. Paying for quality, expertise, or opportunity becomes associated with expansion rather than loss. The brain updates its understanding of risk. Fear weakens through exposure to successful value decisions. Eventually, the discomfort diminishes because value thinking becomes familiar. The individual no longer seeks immediate validation from price savings. Satisfaction arises from alignment with long-term intention rather than short-term reassurance. Money begins functioning as an instrument of direction rather than protection. And once professionals learn to tolerate the initial discomfort of value thinking, financial decisions evolve naturally, shifting from minimizing expense toward intentionally shaping the future through choices guided by impact, leverage, and sustained growth. Now, the perspective shifts toward a paradox rarely discussed openly: how price-focused thinking can quietly become a form of status protection rather than financial intelligence. Many professionals believe choosing lower prices reflects discipline and humility. It signals that they remain grounded despite financial success. Avoiding expensive options can feel morally reassuring, reinforcing identity as practical and responsible. But beneath this behavior often lies something more complex. Price thinking sometimes becomes a way of protecting self-image rather than protecting wealth. Individuals continue emphasizing frugality not because resources are limited, but because spending more challenges deeply held beliefs about who they are allowed to become. Identity resists change. Professionals who grew up associating financial virtue with restraint may feel subtle discomfort when decisions reflect abundance. Paying for higher value environments, superior resources, or premium access can create internal conflict. The mind questions whether such choices represent unnecessary excess. Cheapness begins functioning as psychological safety. Maintaining visibly modest spending preserves continuity with past identity. It reassures the individual that success has not altered character. The behavior appears financially cautious, yet it may quietly limit exposure to environments where higher-level opportunities exist. Value-driven environments often carry higher entry cost. Certain professional networks, learning spaces, or growth-oriented experiences require financial commitment precisely because they concentrate individuals operating at advanced levels. Avoiding these environments purely due to price can unintentionally restrict access to conversations, perspectives, and opportunities that accelerate long-term wealth creation. Fear disguises identity preservation as prudence. You may notice how individuals sometimes reject opportunities quickly by labeling them expensive without deeply evaluating potential return. The decision feels principled, yet the underlying motivation may be emotional consistency rather than analytical reasoning. Price becomes a boundary maintaining familiarity. This dynamic reveals an important distinction. True financial discipline involves intentional allocation aligned with goals. Defensive cheapness, however, protects identity more than wealth. It prevents psychological adaptation to new financial realities. Wealth requires identity expansion. As financial capacity increases, mindset must evolve accordingly. Remaining anchored to scarcity-based identity creates tension between present capability and past conditioning. Money accumulates, yet behavior remains constrained. The individual lives below strategic potential rather than below financial means. Now, something subtle becomes visible. Value thinking does not require abandoning humility or responsibility. It requires redefining responsibility itself. Responsible behavior includes investing in environments that elevate thinking, efficiency, and opportunity, even when those environments carry higher price. The focus shifts from appearing modest to acting strategically. Fear loses influence when identity becomes flexible. Spending decisions stop serving reputation management and begin serving long-term positioning. Money becomes aligned with future direction rather than past self-concept. Status no longer comes from saving visibly, but from building quietly. Professionals who make this shift often appear unchanged externally, yet their financial trajectory accelerates because decisions expand beyond maintaining familiarity. They allow financial behavior to reflect current reality rather than historical identity. And once cheapness stops functioning as emotional protection, money begins opening doors previously avoided, revealing that wealth grows not through appearing careful at every moment, but through allocating resources where value meaningfully compounds over time. Next, we begin to understand how individuals who consistently build wealth approach decisions differently. Not by spending more indiscriminately, but by evaluating value through an entirely different lens. Wealth builders do not ignore price. They simply refuse to let price dominate judgment. Cost becomes one variable among many rather than the defining factor. Their attention shifts toward outcomes, leverage, and long-term positioning. The decision framework expands. Instead of asking whether something is expensive, they consider what problem the decision solves and how long the solution remains valuable. They examine whether a purchase increases efficiency, improves access, strengthens capability, or reduces recurring friction in life and work. Value becomes multidimensional. A higher-priced decision may save years of trial and error. It may introduce relationships otherwise inaccessible. It may accelerate skill acquisition or reduce cognitive load. These benefits rarely appear in immediate financial calculations, yet they compound quietly over time. Wealth builders think in trajectories rather than transactions. You may notice that they often tolerate higher upfront cost when the long-term impact justifies it. They recognize that the most meaningful advantages in modern professional life often arise from asymmetric opportunities, situations where a single decision alters future direction significantly. Price thinking struggles to perceive asymmetry. When evaluation centers only on affordability, transformative decisions appear indistinguishable from ordinary expenses. Value thinking, however, distinguishes between consumption that disappears and investment that multiplies future possibilities. Fear loses influence because evaluation becomes analytical rather than emotional. Another shift emerges in how mistakes are interpreted. Wealth builders accept that not every value-based decision will succeed perfectly. Some investments will underperform expectations, yet they understand that occasional inefficiency is part of participating in growth environments. They optimize across time, not moments. This perspective reduces hesitation. Decisions no longer require guaranteed success to feel acceptable. The goal becomes increasing exposure to opportunities capable of producing disproportionate return rather than avoiding all imperfect outcomes. Confidence replaces caution as the organizing principle. Importantly, this mindset does not encourage constant spending. Wealth builders remain selective. They decline expenses lacking meaningful impact. Frugality reappears where value is low, not where price is high. Discernment becomes precise. Money flows intentionally toward areas aligned with long-term objectives, while trivial expenditures receive less emotional attention. Financial energy concentrates where leverage exists rather than dispersing across minor optimizations. Now something subtle becomes visible. Wealth builders treat money less as a scarce resource and more as a strategic instrument. The emotional relationship changes. Spending aligned with value produces clarity rather than anxiety because decisions connect directly to future vision. Identity shifts alongside behavior. The individual begins seeing themselves not merely as someone managing expenses, but as someone allocating capital, even at a personal level. Financial life resembles strategic positioning rather than defensive budgeting. And once value evaluation replaces price fixation, wealth creation accelerates quietly, not through reckless spending, but through disciplined alignment between resources, opportunity, and long-term direction. Now the perspective shifts toward the final realization, the moment when financial thinking moves beyond price entirely and begins organizing around direction. Throughout this conversation, a pattern has emerged. Price thinking protects money. Value thinking positions money. The difference is not simply financial, it is psychological. One mindset asks how to avoid losing resources. The other asks how resources can shape the future intentionally. Most people believe wealth results primarily from earning more or spending less. Yet beneath those mechanics lies a deeper transformation. Wealth begins when money stops representing something fragile that must be defended constantly and starts representing energy that can be directed. Direction replaces caution as the organizing principle. When individuals focus primarily on price, decisions remain reactive. Each purchase, investment, or opportunity is evaluated independently. Financial life becomes a series of isolated transactions aimed at minimizing immediate loss. But wealth develops through coherence. Value thinkers evaluate decisions based on alignment with long-term trajectory. Money flows toward environments, capabilities, and choices that reinforce a larger vision of life. The question subtly changes from, can I afford this, to does this move me toward the person and life I intend to build? This shift creates clarity. Spending becomes calmer because it reflects purpose rather than impulse. Saving becomes meaningful because it prepares future investment. Even restraint changes character, not driven by fear but by selectivity. Fear loses its central role. Professionals who reach this stage often experience unexpected mental relief. Financial decisions require less emotional negotiation because evaluation criteria become stable. Money no longer carries moral weight tied to spending less or more. It becomes neutral, a tool responding to intention. Direction simplifies complexity. You may notice that individuals operating from value rarely obsess over small price differences. Their attention moves toward larger patterns: how time is used, how opportunities compound, how environments influence thinking, and how resources expand optionality. Wealth emerges from alignment rather than optimization. This does not eliminate discipline. Discipline remains essential, but its purpose changes. Instead of preventing loss alone, discipline ensures that resources remain available for decisions that matter deeply. Money is preserved strategically so it can be deployed decisively. The relationship with money matures. Identity shifts away from being a careful spender toward being a thoughtful allocator. Financial confidence grows because decisions connect to long-term direction rather than short-term emotion. The individual trusts reasoning instead of reacting to price signals automatically. Now something important becomes visible. Broke thinking is not defined by income level, but by orientation. It focuses on minimizing cost without defining purpose. Wealth thinking begins when purpose leads and price follows. Money stops asking for protection and starts offering possibility. When this transformation occurs, financial life feels less restrictive. Opportunities become easier to evaluate. Investments feel intentional. Spending aligned with values produces satisfaction rather than guilt. Even uncertainty becomes manageable because direction provides stability beyond individual transactions. Wealth, in its deepest sense, is not about spending freely or saving aggressively. It is about understanding what money is for. If this conversation resonated with you, consider subscribing to Mindful Wealth. This channel exists for thoughtful professionals who want deeper conversations about money, success, and modern life. Not motivation, but clarity. And if someone came to mind while listening, share this episode with them. Sometimes financial progress begins not with earning more, but with seeing money differently. Until the next conversation, continue building thoughtfully, allowing money to follow direction rather than allowing price alone to define what feels possible.